Ever felt like you need, I don't know, a secret decoder ring for all the government information out there? Especially when it comes to money.
Huh, yeah. A decoder ring would be handy.
Well, you've sent us a fascinating stack of sources all about UK state benefits and HMRC tax credits.
Hmm.
So this deep dive is all about cutting through that, complexity. Our mission is to pull out the most important bits of knowledge from your sources
Right.
to help you quickly get well informed on, well, UK welfare, financial planning, how these benefits impact different life stages.
Yeah, and we'll look at what's available for low incomes, families, those with disabilities, and retirees too.
Exactly.
And what's fascinating here really is how often people sort of underestimate the role state benefits play in their overall financial planning,
That's true.
which kind of raises an important question, doesn't it? Why is this such a crucial area but often overlooked?
Mm.
These sources, though, they provide a really clear, structured overview, from universal credit right through to the state pension. They help us understand not just what benefits exist, but crucially, why they matter to your financial life.
Okay, let's unpack that then. How do state benefits actually affect your financial planning? Your sources seem to highlight two key ways.
Yeah, that's right. Firstly, they provide financial protection. It's about understanding the gap between your existing income or capital and what you actually need.
Right, the baseline.
Exactly. State benefits are part of that existing cover, alongside maybe anything your employer provides.
Oh, okay.
And this helps you sort of quantify any extra cover you might need.
Okay, and here's where it gets, for me anyway, really interesting. The second way is how your own financial circumstances directly impact your entitlement,
Yes,
crucially.
because many benefits are means tested, which means if your income or savings go over certain levels, the amount of benefit you get can be, well, cut.
Absolutely. And your source gives a pretty concrete example of that.
Oh, yeah. A financial plan might look great at first glance.
Yeah.
Maybe it boosts your income. But if that increased income actually reduces your universal credit entitlement, well, it might actually be less beneficial overall than you thought.
So you could end up worse off, potentially.
Potentially, yeah. Or just not as better off as the headline figure suggests.
Yeah.
It just shows how crucial it is to understand these interactions.
And your sources also emphasize that, okay, the benefit structure is complex, eligibility rules change, like, all the time.
Constantly.
But these benefits, even if they seem small, are vital in preventing extreme poverty. It's a huge safety net, really.
A massive safety net, often taken for granted, I think.
So what does this all mean for someone on a low income, then? Your sources dive pretty deep into universal credit.
Universal credit, or UC, yeah. It's the big one here. It's a means-tested benefit, mainly for people of working age, so up to state pension age.
Right.
And its design is actually quite clever. It's intended to allow people to sort of transfer between different types of support as their circumstances change.
So if you move in or out of work.
Exactly. Whether you're in or out of work, it tries to make that transition smoother.
And it replaced quite a few older benefits, didn't it? Your sources list them out.
It did. It consolidated several. Income support, income-based job seekers allowance, income-related employment and support allowance, working tax credit, child tax credit, and housing benefit.
Wow. Okay. So if you were claiming any of those previously, UC is likely what you'd be looking at now for new claims anyway.
Precisely. The amount of UC you get depends on your income, personal circumstances, financial situation. There's a basic allowance.
Yeah.
Plus additional amounts for things like disability, caring responsibilities, housing costs, children, childcare.
Right.
And an important concept here is the earnings disregard.
Ah, yes. Tell us about that.
This basically means a certain amount of your earnings doesn't actually reduce your UC straight away.
Okay, so you can earn a bit without penalty.
You can. So, for instance, a couple with children might have a higher earnings disregard if they say don't receive child benefit. It encourages work.
Gotcha.
There's also a maximum cap, though. The benefit cap on the total amount of state benefits a household can receive, which is based roughly on the average UK wage.
Right, okay. And you mentioned some benefits remain outside UC.
Yes, that's important too. Things like carer's allowance, the new style job seekers allowance, that's usually for people with recent Class 1 national insurance contributions, new style employment and support allowance, disability living allowance, or PIP personal independence payment.
Right, the replacement for DLA.
Exactly. Plus child benefits, statutory sick pay, statutory maternity pay, maternity allowance, and attendance allowance for those over state pension age. So quite a few still separate.
Okay, that's helpful. Let's turn to families now. What support is available for people bringing up children? Your sources break this down a bit.
They do. They look at pregnancy-related and child-related benefits. So for pregnant working women, there's statutory maternity pay, or SMP,
Paid by the employer?
paid by employers, yes, for up to 39 weeks. But there are eligibility rules. You need specific earnings above a threshold and continuous employment for 26 weeks.
Okay. And if you don't qualify for that, maybe you're self-employed.
Then maternity allowance, or MA, is the alternative.
Mm.
Also for up to 39 weeks. It's for those who are self-employed or maybe recently stopped working and aren't eligible for SMP.
Got it. Then there's child benefit.
Ah, child benefit. A tax-free benefit for parents for children under 16 or under 20 if they're in full-time education or approved training.
And it doesn't depend on national insurance or affect other benefits, usually.
Generally, no. But here's where it gets, well, complicated again. Your source is revealed as high-income child benefit tax charge.
Yes. This catches people out, doesn't it?
It really does. If either parent has an adjusted net income over 50,000 pounds.
Just one of them.
Just one, yeah. Then part or all of the child benefit has to be paid back through an income tax charge.
How does that work?
Well, it increases by 1% for every 100 pounds of income over the 50,000 pound threshold. And it's fully charged, meaning you pay it all back once income hits 60,000 pounds.
Wow. But you also mentioned you can reduce that charge.
Yes, this is a really useful point. You can potentially reduce the charge by making pension contributions or gift aid charitable donations.
Because they reduce your adjusted net income.
Precisely. They lower the income figure that HMRC looks at for the charge. So it's a bit of financial planning right there.
Interesting. Okay, this raises another important question. What if you become sick or disabled? Your sources show there's quite a range of support.
There is, yeah. It covers different situations. For short-term illness, you've got statutory sick pay, SSP.
Right. Paid by employers again.
Yes, for up to 28 weeks, as long as your average weekly earnings are above the Class 1 national insurance threshold.
And for longer-term illness.
Then, employment and support allowance, or ESA, is key. This is for people whose illness or disability prevents them from working.
And there are two types.
Two forms, yes. There's new-style ESA, which isn't means-tested but is taxable. And there's the older income-based ESA, which is means-tested.
Okay. And there's an assessment involved.
A crucial part is the work capability assessment. This helps determine if you're put into a work-related activity group.
Meaning you're expected to prepare for work.
Basically, yes. Take steps towards employment. Or, if your condition severely limits your ability to work, you might be put in the support group.
Right. What about help with daily living or getting around?
Okay, so for personal care needs, if you're over state pension age and sick or disabled, there's attendance allowance, AA.
Okay.
For people age 16 up to state pension age, disability living allowance, DLA, is being replaced by personal independence payment, or PIP.
Ah, PIP. Heard a lot about that.
Yes. PIP has two components. There's daily living for help with activities like washing, dressing, cooking, using the toilet, eating.
Everyday things.
Exactly. And then there's the mobility component for difficulty walking or if you're unable to walk.
Got it. And we shouldn't forget carers, right?
Absolutely not. Your sources mention carer's allowance, CA. That's a benefit for people who spend significant time caring for someone who is sick or disabled.
And that can affect other benefits.
It's important to know, yeah.
Mm-hmm.
Claiming CA can sometimes affect other benefits that the carer or the person being cared for receives. So checking those interactions is vital. And if we, connect this back to the bigger picture, it's worth remembering that benefit cap again.
Ah, yes, the overall limit.
Exactly. It limits the maximum weekly income a household can get from certain benefits, tying it to the average UK wage level.
And many we've just discussed are included.
Many are, yes. Things like housing benefit, child tax credit, universal credit, unless you're in that ESA support group, deemed unfit for work, they're often subject to the cap.
Right. Okay. Finally, let's talk about retirement. Your sources give a really good overview of state pensions.
Yeah, the evolution of the state pension is it's quite fascinating, actually. Before April 2016, it was a two-part system.
Okay.
You had the basic state pension and then an additional earnings-related element on top. You might remember things like SERP-ES or the state second pension.
Vaguely, yes, based on earnings.
Exactly. But since April 2016, there's the new state pension. It's designed to be a single level of benefit, much simpler, with no new additional earnings-related bit building up.
So what does this actually mean for people planning retirement now?
Well, your entitlement to this new state pension depends pretty much entirely on your individual national insurance record, your NICs.
Right. How many years do you need?
Generally, you need 35 qualifying years of national insurance contributions or credits for the maximum amount.
Yeah.
It's a much clearer system in theory.
Simpler. Okay. And beyond the state pension itself.
There's pension credit. This is a non-taxable benefit specifically designed to help top up the income of pensioners on lower incomes.
And it has two parts.
Two elements, yes. There's guarantee credit, which tops up your weekly income to a guaranteed minimum amount.
Okay.
And then there's savings credit. This is an extra payment, but only for people who reach state pension age before April 6, 2016, and it saves some money towards retirement. So that's phasing out.
Ah, right. And your sources also mentioned the triple lock. That gets talked about a lot.
A triple lock guarantee.
Yeah.
It applies to the basic state pension amount.
And it means?
It means it's guaranteed to increase each year by the highest of three things. Average earnings growth.
Measured by the average weekly earnings index?
That's the one. Or inflation, measured by the Consumer Prices Index,
Yeah.
CPI, or just 2.5%. Whichever of those three is the highest figure dictates the rise.
Sounds great for pensioners.
It does, on the face of it.
Yeah.
But this raises an important question, and your sources touch on it. It's viewed by, well, successive UK governments as a significant burden, costly for taxpayers.
So there's talk of changing it.
There's been lots of talk, yeah. Proposals for maybe a double lock, just using CPI or earnings, dropping the 2.5%. It really highlights that whole intergenerational fairness debate, doesn't it?
It certainly does. Balancing support now versus costs later.
Exactly.
Wow. We've covered a huge amount in this deep dive. From those big sweeping changes with universal credit to the specific details of child benefit and the evolving state pension.
We have. And if we connect this to the bigger picture, I think the ability to synthesize all this diverse information, to understand not just what benefits are out there, but why they're structured the way they are, how they interact, that really empowers you, doesn't it?
Yeah.
To make better financial decisions.
Definitely.
It really underscores why understanding benefits is such a vital part of individual financial planning. It's not just an if things go wrong thing.
Absolutely. So here's a final, maybe provocative thought for you listening. Given all this complexity, the constant changes, especially that effect where benefits like you see can reduce as your income goes up, how might a future where, say, personalized digital financial advisors may be powered by AI, how might they revolutionize how we access, understand, and plan around these crucial forms of support?
Interesting question.
What opportunities or, I suppose, challenges might that create for managing your own financial future in this landscape? What stands out to you?